Hello, and welcome to Global Data Themes Instant Insights. At Global Data, we define a theme as something that keeps a CEO awake at night, as businesses that invest in important themes will succeed, and those that don't will fail.
Hello, and welcome back to Instant Insights, where today I'll be talking to Steve Blitz, the chief US economist at TS Lombard. Steve, it's great to see you again, making your third appearance on the podcast. How are you doing?
Good, good. I always enjoy being on the podcast. A lot of fun and a lot of fun talking to you and talking about the economy. It's there's always something to talk about.
So yeah, let's get into it. So recently we've had the BRICS summit where the Brazilian president has been calling for countries to create a common currency. And this could shift away from the dollar's dominance of the global financial system. Is it going to happen, or is this a long way off?
It's a long way off. And I think what you'd have to look to is the problems, the advantages and the problems with the euro as the the cautionary tale about having the BRICS under a single currency. The Europeans wanted to create a currency that would challenge US dollar dominance as well as the yen. And it's really failed in that regard. But the problem with the single currency is that you are also adopting a single monetary policy by definition. And you have countries with very different speeds in terms of their growth and inflation and other issues, as we saw most famously with Greece. And a lot of these nations would do better if the euro was cheaper. And this worked or has worked. I mean, from a political experiment, it has held together because, it was the peace and unity project, right? The BRICS don't have that kind of a solidarity in a sense, and they're not going to really create some kind of a unity. I mean, what does Brazil, China, and India have in common other than the fact that they're, emerging market countries, right? You could say, well, we just want it as a trading currency that's based on some kind of a weighted average of the size of these various countries, and that's all. That's a great idea, but its execution over time is going to be more difficult. How do I value it? The dollar isn't going anywhere. I think it ebbs and flows, and it's not, after World War II, it was 75% of the global economy. It's only 25% of the global economy. So, of course, it's going to be a smaller share of the currencies that are held, but we're still the biggest, we're really still the biggest economy in the world. So,
So
anyway,
it doesn't
not,
sound
not,
like
a,
you're
not,
too worried at all, really.
no, I'm not. And the idea that China and India, who are rivals on all sorts of different levels, not just economic ones, but also border, military, are suddenly going to agree to a currency to tie their currencies together and have a single currency. Good luck with that.
Yeah, I think especially in the case of Europe, even before getting to a single currency, the European community started out as like the European coal and steel market, I believe. So there was only a tiny
Yeah.
bit of integration, and then it took decades and decades to finally get to the point where there was a monetary union. So I can see what you
Right.
mean. It's not just going to happen overnight. There's all these
No.
countries agree on a common currency. So
Right.
yeah. While we're on that topic of Europe, why do you think the US economy is in much better shape than Europe's right now? What's Europe doing wrong?
The problem with the European economy is that really it's narrowed itself to growing on net exports, right? So its real source of growth is the German export engine. The banks there are still weighed by the bad loans that accumulated through in 08, 09, in that period of time. They've never really recapitalized them and dealt with it. And part of that is because you do have a patchwork regulations, in regard to the banking system, right? Because you still have all these various central banks. There's still a Bundesbank, for example, but there's an ECB. And what the ECB can do and what the Bundesbank can do. I mean, the line's been blurred post 0809, but there's still a lot of issues there. And then getting back to the point of the single currency, the Germans refuse to really have large budget deficits. Italy doesn't really want to move from budget deficits to more balance. And so, you have a lot of entrenched interests in the status quo. And you don't have a dynamic growing population. You have an aging population, and the only way you grow your population is you're importing people from the rest of the world. And so all of these things, it's not like some of these things the rest of the world, like the United States, et cetera, aren't immune from. But you just don't have the big dynamic, and also you don't have a big dynamic tech sector, right? So tech chips, you think the U.S., you think Japan, you think South Korea, China to some extent as well, right? But there's no NVIDIA in Western Europe.
Yeah, well, we only had the UK only had ARM, and then that's gone and listed on the New York Stock Exchange, moving away from London, carrying on that exodus.
ARM, it makes more sense for me to go to a large global exchange with a deep capital, and obviously that's going to be a U.S. equity market.
So while we're on the topic of the US, despite the record sort of raising of the federal funds rate, how do you think the US economy has been so resilient?
It's not so much a question of resilience as it is a change in the structure of the US economy. Part of it is that, we run a big trade deficit. 80% or so of what consumers buy in the US is imported, either directly imported as goods or the bits and pieces are imported and things are assembled in the US. Like with cars. And so that when there is a manufacturing slowdown, the impact is not in U.S. firms in terms of U.S. activity here, but in the rest of the world. The biggest domestic industry that we have that is very susceptible to interest rates is obviously housing. And housing as a percent of GDP is about less than 4% of GDP, when say 2008, it was 7% of GDP. So even if you were to hit housing, its impact on the overall economy is smaller. I think the US economy is less sensitive to interest rates. The triggers to recession have changed. If you look over the last 10, 15 years, there's been a tremendous amount of growth of assets, financial assets relative to liabilities on the part of both business as well as certainly households. Households have delivered, businesses delivered. So all of this makes the economy less sensitive to interest rates to drive growth down, simply because you're not borrowing as much as you were. The federal government is borrowing a lot more, but A, they're somewhat impervious to interest rates, and two, the Fed buys, a good share of what's issued.
Whilst we're on the topic of interest rates, it'd be great to finish off with your predictions of what you see happening in September's FOMC meeting. Are rates going to be held steady? What do you think?
Yes. That one, I'll give you a very short answer. I'll give you a short answer to that one. Yes, they're not going anywhere. I think the real question is, what do they do in November and December and on? And, it's just, obviously it's going to depend upon the data. I think the Fed believes that they've got interest rates, policy rates at 5.25%, 5.5% range for the funds rate at a comfortable level relative to inflation.
Thank you very much, Steve. So our listeners have heard it here first. The funds rate will stay the same in the upcoming meeting. And as always, thank you so much, Steve, for those instant insights. It's been a pleasure having you on. And from us at Global Data Thematic Intelligence, we'll see you all next time.